Hi, good evening, everyone, and welcome to the current edition of your Market Navigator series. As you are aware, that this is a series we've been running for a few months now, every week, wherein we intend to cover a product in focus while asking questions to the concerned fund manager around the markets, around the products, and what thought goes behind while creating a robust portfolio of that product. We also want to understand what are the processes as a fund house we follow while managing the equities as a whole and a product in specific. And this thought came to us while we were chatting to one of our partners who suggested that let us ask the questions to the fund managers directly because we'll be able to present the questions, the apprehensions, and the ideas from the distribution side. And then this is with this thought, we started this freewheeling conversation between our fund manager and one of the esteemed partners from the market. Today with us, we have Mr. Mahesh Patil. As you are aware, he is our Chief Investment Officer, taking care of both debt and equity, overseeing a total AUM of more than 3 lakh crores with us. Mahesh has over 30 years of experience in fund and investment management and leads the entire investment team comprising of all the fund managers and analysts himself. He personally manages funds like Frontline Equity, which is the fund in question today, apart from managing focused equity and multi-cap fund. He has been with Aditya Birla Sun Life AMC since October 2005 and has been awarded India CIO of the Year Equity by Asia Asset Management in 2016. Internally by the group, he has also been awarded Chairman's Individual Award for being an accomplished leader in the year 2015. Previously, he has been associated with organizations like CMC Limited, Tata Economic Consultancy Services, Parag Parikh Financial Services, Motilal Oswal, and Reliance Infocom. He holds a bachelor's degree in engineering from University of Bombay and a master's degree in management studies from, again, University of Bombay. Being a qualified chartered financial analyst examination, he has already qualified and from Institute of Chartered Financial Analysts of India from Hyderabad. Although he never needed an introduction, but I thought that we have such a large audience coming on the forum, it will be worthwhile to reintroduce myself in this forum. We have also joined with one of our esteemed partners from Bangalore, Mr. Shrikant Bhagwat. Mr. Bhagwat is Managing Director and Principal Advisor of Hexagon Capital Advisors. He founded this company in 1997 in Bangalore. It is a specialized wealth management and financial planning company working with high net worth families from various backgrounds, scientists, authors, IT professionals, CXOs, and even venture capitalists. In recognition of the ethical and trend-setting practices in the area of work, Hexagon has been awarded Best Independent Financial Advisor South by CNBC TV 18. Hexagon is a registered investment advisor. Mr. Shrikant himself has written for many newspapers and magazines in the past, including Deccan Herald, Dalal Street Journal, etc. He has also been interviewed or featured in Economic Times Mint several times. He has served on the jury of Wealth Forum's Best Financial Plan competition in 2017, being an avid blogger and a popular speaker at professional conferences across the country. Beyond the interest of being into caring the society on their financial services, he is an active member of Corporate Laws and Taxation Committee of Federation of Karnataka Chambers of Commerce and Industry, active Rotarian, and served on its board in the past. And currently, he is the president of Rotary Bangalore Midtown. He is a mentor and founder in Institute, a technology startup accelerator to promote entrepreneurship. He is actively involved with service activities and is a part of Sri Satya Sai organization. His interest, apart from what all I have detailed to you right now, is also into travel writing and photography to motorcycling. So we have two wonderful gentlemen joining us for the conversation today, right? And I believe that the interest will surpass all the communications that we have only around the financial services. So with this, I will hand it over to Mr. Mahesh Patil and Mr. Shrikant Bhagwat to have a conversation around products, markets, and whatever interest you feel like. Over to you, sir. Thank you.
Thank you so much, Tarang. And as you truly said, Mahesh Patil needs no introduction. He's one of the few people that we have in the industry who have been managing one single fund for so many years with amazing results. Okay. And Mahesh, it's an absolute privilege to be conversing with you today on this technical topic of your fund. Okay. Uh,
Thank
I
you,
will.
Shekhar. Yeah, I think it's my privilege also, I think, to be interviewed by you. I think you are also have your own standing in the industry. So, yeah, good evening, everyone.
All right, great. So, Mahesh, I will ask you a set of questions which I think would be of interest to everybody. And shall we start?
Yeah, sure, we can start.
Okay. You know, biases have been a topic of great discussion over the last couple of years. It seems to be a trend and a fad, psychometrics and psychological biases. So I'm also submitting to what is called a recency bias as of now. And we'll talk about recent events to start with. Now, we have all gone through a especially trying time over the last 1.5 years. We've gone through an experience which we have never gone through in the past, and I hope we won't go through again. The kind of pandemic that we have gone through. Has your portfolio undergone a change before and after? Has your philosophy undergone any change because of an event like this, Mahesh?
Yeah, so I think any event, and especially a catastrophic event like this pandemic, I remember, is always a period which provides opportunity also. There are challenges also which are there. And it is also a period of learning, right? You always, because these kind of events happen probably once in a decade or so. I remember in 2008, after the global financial crisis, again, a similar period, okay, where we saw nobody would have fathomed that the markets would correct by around 60% or so or more. And it was a unique situation. And that period, I think at that time, I was probably been probably around, say, 4 years in the fund management industry and was taken by surprise. But that really taught me a lot of things, right? Like, for example, whenever there is panic in the market, while everything goes down, and it's challenging, but it's also an opportunity. If you're able to really keep your mind steady and really look beyond the volatility or beyond the noise, then actually that's the time when you can actually get good quality stocks at a reasonable price. Normally what happens is that all the good stocks, they are always expensive because they are sought by investors. But it's during the crisis where you can actually build up a portfolio which is much more solid, good quality stocks. And that helps you to really not only bounce back well, but also helps you to sustain from a long-term perspective in terms of delivering on performance vis-a-vis the benchmark. So I think that learning, and also it tells us that you need to also have the right amount of discipline in the portfolio to able to weather these kind of shocks, especially in terms of how do you manage the portfolio from a risk perspective, the concentration risk in individual stock, how much you should have. So all these things, learnings were there from the 2008 crisis, and we have been implementing that learnings in the fund, and we had a fantastic run for this fund from 2012 to 2017. Then there was a couple of periods, 18 and 19, where the fund went through a rough patch. We'll talk about that later. But clearly from this crisis, okay, this was one of the crises which probably unique in that sense. Okay, it was not driven by any economic risk, but because of the virus, and it impacted everything, right? So it really hurt on the demand side. There was a big disruption which was there, and equally true was that the fact that the bounce back what we saw after the correction was very fast. I mean, this was the fastest rally which we saw even in my investment history. So I think that was the clear differentiating factor at this point in time. But I think from our perspective, I think what we did was, as even getting into the pandemic, I think we were trying to restructure our portfolio, especially the frontline equity fund, after the period of underperformance which was there in calendar year 18 and 19. Again, that that was again a unique period, right, where we saw that there was a very narrow rally in the market, where only the top 5 companies in the Nifty would have actually driven the bulk of the performance. And the fact that we ran a portfolio which was more diversified post challenges, also large index weight stocks like Reliance and this thing, we were severely underweight because probably didn't fit into a valuation framework. And we had seen prior to that a big rally in quality stocks. High quality stocks continue to go up at any price. And our philosophy as a fund house, and even for this fund particularly, has been growth at a reasonable price. So many of the good quality stocks which were there, we used to have them earlier in the portfolio. We sold them off because they become very pricey and they continue to rally. And that hurt us, okay, in that period when quality did well in 1920. So what we did was, in this period, okay, when the crisis hit in, everything fell. Initially, in the first 1-2 months, everything went down, right? And especially the consumer stocks or good franchisees, consumer retail franchisees, they also came down. And we took that opportunity to build some of these high quality stocks in the portfolio, which earlier we couldn't buy because they didn't fit into a valuation framework. They were very expensive. But in the correction, we added a few of these names, for example, in the consumer staples names or in the some of the other consumer durable side. And that helped us, okay, not in the recovery also, but going forward. So that was clearly one kind of a change we did in the portfolio. We took this crisis as an opportunity to really build up growth stocks at a reasonable price, because normally growth stocks are very, very expensive. And apart from that, I think what we did was also in this period, see, we had a feeling, the market was getting very, very narrow. We saw that rally in the market. But after the crisis, we've seen that the overall recovery, what we're seeing because of the liquidity coming into the market and the underperformance of a lot of these stocks, small cap and mid cap, we were fairly confident that you would see a broad-based rally in the market compared to the narrow rally what we had seen earlier. And a lot of sectors which were kind of beaten down or negative, the outlook there was looking positive. So in this period, again, we tried to slightly broad-base the portfolio because now there were a lot of more sectors, okay, which were looking positive, at least outlook going forward based on the macro recovery. And that's why we tried to broad-base the portfolio a bit, looking at more ideas, companies, okay, which are probably, again, this pandemic also was unique in the sense that it brought to the fore the companies which were at the cutting edge of technology or on the digital side, which were well prepared. They could seize advantage of the situation much better and bounce back much stronger. So I think looking at each sector company which were disrupting because of technology and able to gain that advantage, I think we've bet on those names, be it in the financial services sector, like stocks like Bajaj Finance, for example, or be it in other sectors, allied sectors, on the consumer side, companies which were more prepared on the digital side, making right investments, okay, to capture in the new world where we are right now, where we are seeing a lot of movement moving towards online because of the larger penetration of mobile phones, cheaper data. So this was a kind of inflection point for that. And that's where I think we try to orient a portfolio from a slightly longer term perspective. So so I think these were some of the changes I think which we did to the portfolio. Apart from that, I think the broader philosophy never changes, right? The philosophy what we are running this fund in a disciplined manner, trying to ensure that we don't take unnecessary risks in the portfolio. We also take measured bets at a stock level and at the sector level, which was a discipline which we have been doing for the last 15 years, and that's been the reason for the consistency, and that all remains. But I think a minor change in this style, I would say, in terms of trying to look at more growth-oriented stocks at a reasonable price. I think that's what has helped us also, okay, to bounce back much faster in this market recovery.
Yeah, that's interesting, Mahesh. When you speak of disruptors and taking advantage, but I have 2 points here. Uh, a, s- a stock like Bajaj Finance has been a disruptor because of its use of technology, as I understand. It is something that has been in your portfolio for a long time. So when you come across an event like what happened in 2020, did you get the chance to add on to positions, or were you able to take such advantage? Number one. Number two, we don't have too many disruptors in an environment such as India in the listed space. So how do you deal with this?
Yeah, so I think you're right. I think Bajaj Finance has been a core holding of a portfolio. I remember 2012-13 when we first looked at this company. This was the company which is coming through a crisis again. If you remember, Bajaj Finance in 2008, after the global financial crisis, had a major problem on the unsecured loans. And it was in deep problem. But then they came out of that, they tightened their risk management. They were the first company, in fact, we met them. What impressed me at that point when was that, I mean, way back in 2012, they were looking at building up a digital infrastructure to be able to really manage risk well, because lending is all about managing risk, right? And they were investing in that since then and trying to use data analytics to really decide, okay, where to lend. And that's what really impressed us. And obviously the leadership also, right? And we took a good bet at that point in time. The stock has been a multi-bagger. It's up almost 100 times, okay, in the last 10 years. But as it became expensive, the mistake which I did was, and if I had held on to my position, which I had way back in 2012-13, I think you would have seen a much larger weightage in the portfolio. But I think the philosophy, what we had been going by in this fund at least, was that we also were disciplined in terms of booking profits in stocks, okay, when they reach a target price or where we think that the stock has fully played out. And that's what we did in Bajaj Finance when the stock became very expensive on a price to book value, say around 6-7 times price to book value. And we probably kept our position at around whatever 2% or so. Otherwise, it would have been like 5-6% of the portfolio. But during the financial crisis, I mean, during this COVID pandemic, again, there was a large correction across financials. And that was a period, again, where the company was coming out with this digital platform, right? And we thought it was the right time for this company to really take advantage, though there were near challenges in terms of the asset quality. And as we got more clarity, we took this opportunity to really add to the portfolio, because I think any company which you have tracked and once you're confident about their risk management, their management, I think you know that they will be the first one to bounce back, okay, when things normalize. And with the focus on technology and at the forefront of digital, I think then, you know, there's a winner at your hand, okay, which can able to really not only take advantage of the situation also, but really transform itself to be at the forefront and continue to grow at a faster clip than the industry. So yeah, so I think we were able to really add to our positions, okay, when stock corrected, and it continued to outperform, and it's been again a biggest gainer in this whole last 1 year.
So this idea of disruptors, again, coming back to, we hardly have any disruptors. Bajaj Finance is one rare case, I would think, Mahesh. Am I wrong? I mean, do you find, because you visit some far more businesses than I do?
Yeah, so you're right, actually. Disruptors, again, there are very far and few, though I would say that the things are changing. There are a lot of new companies which are coming to the market. I mean, you would have never thought, I mean, at least I would have never thought that you would see a lot of these unicorns, so-called, or the startups coming to the market so early. And we have seen in the last 6 months, 9 months, many companies, the so-called disruptors, whether it is in the food delivery platform like Zomato, which is there, or disruptors in the auto space, like electric vehicles. We've seen companies like Sona Comstar come in. So there are a lot of companies which are now coming to the marketplace through the IPO route, and that is changing the whole landscape in terms of what we can participate in this space. And the pipeline also is fairly good in terms of new companies which are lined up for IPOs coming down the line. And it's a very different ball game trying to view and analyze these companies, because some of these companies have an established model, they have cash flow, they are profitable, like Bajaj Finance, okay, or the likes. But there are the new generation companies coming up which are probably don't have profits, right? But they are doing incredible work in terms of getting customers and trying to disrupt the landscape, because they have to invest a lot. But they can create profits as they gain scale and size. So we had to really look at and evolve in terms of our model, in terms of how we look at companies, to look at some of these new companies where there is no profits, there are revenues, and how do we really model these companies and see which of these companies will be winners going forward. So I think we are increasingly seeing more opportunities there. And again, in our frontline fund also, we have tried to take some exposure. We don't want to take a large exposure in disruptors because they're still new, nascent. Some of them are very early in their growth state, and we would like to monitor them over a period of time before we take large positions. But clearly, we have taken smaller positions, I would say, in a portfolio, and they have done well for us. And we continue to evaluate, I think, these funds, these kind of disruptors in across domains. Because I think that's the way I think you will find some of these future winners. And we have parallels of these in other developed markets, right? We've seen some of these companies came in early and they've been able to grow very fast in market capitalization. And if you had a very fixed mindset of looking at a company based on PE multiples, then you would never be able to participate in this kind of approach. So we have a very balanced approach, okay, when we look at the conventional companies, the traditional companies, and the disruptors or the new age companies. But I'm pretty excited in terms of the new companies which are coming into the marketplace, and we are actively looking at there is a lot of work over there to be able to identify and look at which are the companies which we should be looking at, okay, where we see them creating wealth from a long-term perspective.
In that context, Mahesh, can you tell us more about one is the growth at a reasonable price of the GARP model, and how do these companies fit in this worldview?
So this is a different concept altogether, as I said earlier. I mean, the traditional growth at a reasonable price is what we would apply to your traditional companies which have got a track record, a history of cash flow, a history of profitability, which is there. But when it comes to these disruptors, again, that's where the challenge is. I mean, you have to have a different hat. And certain part of the portfolio you need to really look at from that perspective. And so this is something which we are still evolving, how to look at. You have to look at the bigger opportunity, the target market, what they are going to address, as they call it, the TAM, and look at the bigger picture. So it's more of a top-down heavy approach when we look at these disruptors, and because you will never be able to buy this stock if you look at the conventional metrics, and they will never be at a reasonable price, so-called reasonable price, which we say. Yeah. So then you have to really look at other matrices. I mean, revenues, okay, market cap to revenues. You have to look at the unit economics, okay, whether the unit economics are good, because these companies are going so fast that they're investing in that. So you'll never see profitability on a steady, on a today's basis, right? But the unit economics are good, and that's what we focus on. So there are various other matrices which we have developed to look at these companies. The unit economic is good and then profitable over there. So sooner or later they will start making a profit as they gain scale and size. So yeah, so everything doesn't fit into our philosophy, but we have to make some adjustment, and that's why I think we are flexible and nimble, because we have to adapt to the new scenario, okay, which is emerging for us. And this new scenario also offers opportunities, and unless you really not adapt and change your approach towards investing, you will miss those opportunities. And we are still learning there. It's not that we have got it right. We'll make some mistakes along the way, but unless you don't try, you will never learn, right? That's how we are taking it.
Yeah. So when these companies hit the market, they're still not large caps, and whereas Frontline is a large cap fund. So you're allowed to have some of these stocks in the portfolio. To what extent do you like to do this, Mahesh?
So you're right and wrong, because some of these disruptors, because of the market valuations or whatever they are, or when they come to the market itself, are large cap, like recently what we saw, right? Whether in the case of Zomato or probably another Paytm which will come in, these are pretty large cap names. So yeah, so I think while this fund philosophy is to invest into large caps, it has the ability to or potential to invest into mid caps up to say around 15% of the portfolio. And we utilized that earlier pretty judiciously wherever we wanted to get into stocks which offered higher growth and higher alpha, okay, to generate that. And we'll use that. I think, again, as I said, in these digital disruptors, we won't take a large weightage. Like initially, we would take just 0.5% of our portfolio. And that can fit if it's a large cap or even a mid cap. We won't really get the small caps over here. But if a reasonably large size mid cap, okay, we would definitely look at it. And that will be probably part of the overall mid cap allocation, which, as I said, will normally vary between 10 to 13, 14% in that range.
Alpha is a real hot topic now. Okay, wherever you see, wherever we read, alpha is a topic of discussion. It's coming to the fore now, I guess, because in many of the funds, we have seen alpha diminish or be negative. Okay, even in the case of frontline equity, there's a period, especially the last 5 years or so, that we have seen a negative alpha. What are your views on this, Mahesh? Is alpha something that is only a bonus investors should not expect, or is it something that you are driving at getting, and the last 5 years is an aberration, or the last 5 years is a trend?
Yeah, so I mean, the whole question about alpha generation, and I've seen that, right, in the last 15 years. I remember frontline equity used to generate an alpha of around 400 to 500 basis points on an average, right, consistently for many years.
Right.
But then we had this period of 2000, whatever, 17, 18, or 18 and 19, where things changed dramatically because, for whatever, the way the markets were, index funds were coming in, money was moving only into a few index stocks. And passives also slowly started to really gain prominence in that period. And that culminated, that 2 years took away a lot of alpha, historical alpha. And that's why we're seeing the last 4, 5 years, the alpha has come down and beating the benchmark has become a challenge. So I believe that clearly, I think as the markets become more mature, as we see more passives coming into the market, the alpha generation will come down, and which is definitely happening. But but I think ability to generate alpha is still there. I think those 2 years, okay, where the fund underperformed the benchmark significantly, and that took away the alpha. I think that was a unique situation. I think in that context, and we have discussed that earlier. We've seen things changing now in the last 1 year. If you look at the market as becoming much more broad-based, so there are different cycles in the market, right? There are cycles when you see quality does well, a certain period when value does well, periods when a few large stocks do well, a period when the market becomes more broad-based, and that's the nature of the market. So we are now seeing a phase where the market is becoming more broad-based. There are much more sectors which are now participating in this market rally. And that is giving opportunity for fund managers who normally take active bets vis-a-vis the benchmark to generate alpha. And we have been able to do that. So I think I still believe that we can still, a fund like frontline equity fund can still deliver around, say, close to 200 basis point alpha over the next, say, 4, 5 years. And then I think we'll worry about that later in terms of how the how the passive funds really grow big and drive the market. The beauty of Indian markets is that there are a lot of new companies which are coming. India is still a growing market, is a growing economy. There are new emerging companies which are coming up either into emerging sectors or within the existing sectors, and able to generate good returns for investors. So we can always participate that in the fund through active calls before they become large enough to become part of the benchmarks. And that provides a unique opportunity for fund managers, as I said, in India, okay, to generate alpha. So I think I'm still in the camp that it's been difficult in the last 3 years, but now things are changing because the nature of the market, how it is changing. and there'll be reasonable scope to generate alpha, though probably half of what one has delivered in the last decade or so.
So the earlier decades alpha, you think, was because of more of mid-cap stocks allowed in the portfolio? I mean, that was before the SEBI regulation came, right? As compared to post 2018, would you attribute it to that, or market dynamics by itself?
Yeah, I mean, it's a combination of that. I think that's not one of the reasons, because each fund had a particular mandate, right, in terms of what mid cap or large cap exposure they could take. But it was more because we were seeing across the sector, okay, during various phases, there was multiple sectors which were doing well. It was not as if the few large companies, okay, which were really driving performance. It was market breadth was much wider as passive started to gain dominance, right? That's a phenomena in the last 3-4 years. We have seen that, especially at a time when the market sentiment is a bit negative, economy, the broader market collapses and money gets concentrated only into a few large stocks, because that's where the passive is still continue to allocate. And that led to the disruptions, okay, what we saw, and reduction in alpha. So I think that scenario will continue, right? You'll see passives continue to play a role in the market. But otherwise, I think the breadth of the market, the mid cap, small cap allocation, and these are more cyclical in nature. That there are periods where there is more opportunity in the mid cap and small cap space, especially at a time when you're seeing the domestic economy does well, right? So I mean, our economy started to decelerate since 2018 and 19, right? Because of various reforms or whatever, after demonetization, then GST. And that's the reason why we saw many sectors suffered in that period. And that's what the reason why the market breadth was very narrow. But I think that is changing now. So I think that's the only change I see. I think otherwise, I don't think it's because of more ability to invest in the mid and small cap. It's the whole nature of the market which has changed.
So that's a good sign actually then, and very positive. One thing puzzles me. You did say you have a growth tilt and you prefer to look at growth stocks. But if I look at the style grid of frontline equity now, okay, you have very less stocks, the growth and value, and more of it in what you call a blend. Okay.
Yeah.
So how do you explain that, Mahesh? I mean, at the same time, we said that quality stocks were available at a good price and you loaded up on quality stocks.
Yes. So I think it's always been a balance in this portfolio. Frontline equity is always about a balance. And we never really gone overboard on growth or value. We make some marginal tilts to the portfolio depending on where do we see opportunity at, depending on what cycle we are in the market or in the on the economy. And it's always been a good blend of value and growth. And whenever we see distortions in the market, right, whether it's on the value side, the fund has also taken opportunities to be contrarian, right, in a few sectors, okay, when they were down and value. So you would see in this fund also some PSU stocks, right, which is we won't see that in some of our other funds. But again, I mean, if there is value there and if you see compelling reason and the market is still ignoring it, we'll still take a bet on it. Be a patient over there, but not a very large bet. So you have some of these deep value stocks, contra stocks also. Like we took a contra bet on real estate. I remember in the earlier cycle also we did that. Even this cycle, we took very early bet on real estate stock like BLF, which we have in our portfolio, which we got very early in this downturn, and have a measured. I mean, again, it's about playing everything. Look, in a measured way, because you don't know what will work at what point in time. As long as you see value and you're willing to wait out, it will fire or it will get realized at various points in time. And that's what helps you to maintain. If you want to really consistently outperform, right, the benchmark, then you need to have a style which is having a blend of across team, right? Because you don't know what will work at various points in time. I mean, if you have a particular strong distinctive style of growth or value, they will do well over a longer term, but there will be periods where there will be significant outperformance and there will be periods where they will significantly underperform. So our philosophy in frontline equity fund is to be more consistent vis-a-vis the benchmark, right? So in that sense, we look at, while our bias is towards growth because we believe that India is a growth market, and growth will deliver long-term value to you if you're able to buy at the right price. Right? That's where the bigger alpha would be. But the market doesn't give you opportunity every time to get everything at the right price, right? If it was so easy, then you would just buy some of these good quality growth stock at any price, which some funds follow that philosophy, but we always looking at the right distortion in the market. And distortion can be in the value side at certain point, and it can be in the growth side. It can be in some of the stocks which are ignored, or contra stocks, or some cyclicals, okay, which could be down. And that's what I endeavor is to really spot those distortions in the market and benefit out of that.
So that brings me to the point, what are the challenges you face at this phase of the market, at this kind of an index level? I'm sure you have your challenges. We'd love to hear about that. And then also you would probably continue as to where do you see the near future for the economy, the market, which sectors are likely to outperform and give alpha? Mahesh, please. Good.
So it's been a challenging market in the sense that we haven't seen such a kind of a one-way rally, right? In the market, and especially at a time when there is still uncertainty around, right, in terms of economic growth, how fast it will come back. We have a second wave. We had a second wave of COVID, fear about a third wave. But market is totally ignoring that, and it's just going up. Valuations are getting stretched, not only in India but also globally. If you look at where S&P is now, right, it's like a in a zone which is like euphoric zone, right? What was there in 2000 and 2008. So that is always a worrying factor at the back of the mind, right? At the same time, also India, if you look at it, we are at the current phase, we think, where we are. I think this is the best time for India to be in, right? We've had our own challenges. We went through a slowdown. We had our reforms, and we are poised now really to capture, okay, the growth and leading position of growth amongst the large economies in the world. A lot of things are falling in place for India, and that's why you want to be still optimistic, right? Positive on the longer term outlook. So, but stocks valuations are where they are. So then one has to really look at relative. So beyond a point, you can't really fight the market, right? Only thing what we can do is try to ensure that the portfolio is well built, so that if there are any shocks, any correction in the market, we should be able to wither that. And that has been a thing which we have been trying to do, because while we might not have comfort in terms of valuations, but then the focus is on stock specific, right? If you have comfort in the stock, the management in terms of growth, then I think your relative the stock will do well, even if there is a market correction. And that's what our focus is. And I think the biggest challenge has been to sitting on stocks which have been outperformers for you, biggest outperformer, right? Because a good stock which is done well, outperformed, it's probably expensive. And how to hold on to your winners in the portfolio has been a big challenge. It's been a big learning also. I gave an example earlier about one stock, okay, which has been a big winner, but we trimmed that holding. So the challenge is to really hold on to your good quality stocks, your winners at these levels, and how to get the right balance in the portfolio, so that you also have to look at other stocks which are still not fully discovered, or which are still not probably laggards, right? Which have been laggards in the market, but they can turn around going forward. So I think that has, been the biggest challenge. And there is also been a lot of sector rotation, which is happening very fast in the market. I've never seen such a fast sector rotation happen earlier. And normally you would take a call on a sector, it would probably play out over the next 1 year, 1.5 year, or 2 year period. But now rotation happens every 3 months, right? Suddenly we see the IT sector comes back, then the banking sector takes precedence, then the commodities, metal sector comes in, then the pharma sector. We keep on rotating. And then to be able to move across sectors becomes very, very challenging and difficult. So you need to have a very clear view, long-term view, which sectors will do well, and be positioned in there, because they'll come back again, right, with the lag. So to answering the second question, how we position which sectors which we see doing well going forward. So up till now, we've seen the global cyclicals do well in the last 1 year, because the recovery in the global economy much faster on the back of the huge liquidity. And we saw sectors like IT sector do well on the back of that. Commodities also did well. on the back of that. A lot of export-oriented companies also did well. The domestic link sectors were lagging behind. But I think going forward, I think coming out of this pandemic and with the whole foundation being there, we think domestic cyclicals will start to do well. And India is in the boom where we see, while there has been job issues, but there's a lot of money which is coming into the country, and especially in the startups and the whole ecosystem, which is creating a huge amount of employment and cash at the hands of the consumers. So consumption, domestic consumption, I think will continue to drive in India. That's the beauty about India, demographics. So, and as the per capita income is going up, we are at an inflection point also in per capita income where we see a lot of consumption of small ticket discretionary items starts to go up where the penetration levels are low. So that's the one long-term secular thing which we believe. So we'll see our positioning in a few consumer durable stocks or consumer discretionary stock, which we think will do well over the next decade or so. And that will continue. Again, the shift from unorganized to organized has only further accelerated after this COVID crisis, right? We've seen that play out after GST, and companies which are there in sectors where there is still some amount of unorganized play, they can continue to gain market share over there and grow faster than the industry. That's one of the themes which we would like to play over here. And I think for the first time, we are seeing some recovery in the industrial capex. We're getting slightly positive over there. For the first time in the last 4-5 years, we are seeing green shoots in industrial capex, driven by I think India, the whole globe looking at India as an alternative supplier to China. So that creating investments in India, especially in a few sectors, whether it is textiles, whether it is chemicals, whether it is pharmaceutical API or auto ancillaries. And I think that's, so the whole industrial sector, investment-led sector, which is there, I think for the first time, we are getting positive on that and that space. So that's, again, it's a cyclical sector, but looks promising if you take a next 3 to 5 year view. And I think the broader recovery in the economy, while it is still slow, we think that will gain momentum. So to play that, the banking and financial services sector is one sector which one can play that too. This is a sector where the valuations are still not as expensive as some of the broader market, I would say. The valuations compared to the long-term averages are still okay. Only thing is the sector is going through disruption. You'll be very clear in which companies you want to bet in the financial services sector, right? Companies which have got a strong leadership at the top, the vision over there, and investing into technology, right, to be able to stand with some of the digital disruptors. So these are the companies which will do well. And the whole savings, right, financialization of saving, which has been happening, the economy will only gather pace. And we've seen that after the COVID crisis, there's a lot of savings which are there at the hands of the consumers, which they'll partly do into, might go into financial saving, like whether it is insurance business, again, which is coming to the fore after the COVID crisis. So we like the insurance companies, which are much more secular in growth. And looking at the penetration level, there is still a long roadway for growth over there. Real estate sector also is a sector which is for the first time looking promising after, again, 5 years of a downturn, again, driven by low interest rates, driven by decreasing the overall inventory which is there in the system, more organized player coming into real estate, the cost of funding to real estate has coming down. So that again is a sector which looks promising from a long-term perspective. So these are some of the sectors and themes which we like, and we are playing that whatever way we can in our funds.
You're not overweight IT, but you're overweight the banking and financial services part. I think that's the only area where you're overweight, no?
So we are IT also, we like the IT sector, and we have, I'm slightly marginal underweight, okay, neutral-ish or marginal underweight. IT has played out very well and will continue to do well in terms of its outlook, growth, but valuations there look to be a bit on the higher side and probably discounting that. So if you want to look at the next sector where the growth could be, banking and financial also, we are marginal overweight, okay, you can say. But our larger overweight at this point in time would be in consumer durables sector, consumer discretionary, as I talked to you about. Telecom, again, it's a very small sector, but telecom, again, we think that the sector is coming through a lot of pain. There's a consolidation which has happened over there. You would see some pricing improvement going through. And and for the first time, you will see now free cash flow generation in the sector playing out. So telecom, again, is one of the sectors where we are under. So otherwise, we are kind of neutralish in most sectors. And a large underweights would be in sectors like oil and gas and auto at this point in time.
There is one popular private sector bank which has been moving down their list. Is it because of technology and leadership issues?
Is it moving
down your list? The weight of it has been reducing over the last few months.
Okay. Yeah. So I think, again, we always look at companies where at the margin we are seeing a change, right? It could be a stock, okay, which has done well, good company, but especially when the landscape is changing, when there are a lot of changes which are happening, we want to bet on companies which have been able to take the necessary investments, okay, to adapt to the changing environment. Because I think the investments which company make today in their business for future growth, these are companies which we like much more, because then they are preparing the organizations for the future disruptions or the future growth or the future opportunities which are there. And companies which are slightly behind that is something which will probably lag a bit. And that's where our shifts are probably happening in the sector. I mean, whether it's the banking sector or any other sector.
When I was reading the news yesterday or today about Z, and Z is a company which has singed all of us over the last couple of years in various manners. And I see that, a while ago, it has quietly entered your portfolio. How did you decide on this company? What made you get it back into your portfolio?
So, I mean, these are some of the kind of a contra plays of value stock, deep value stocks, right? Okay, where, as I said, you take some small bet because this industry is going through a lot of disruption again because of OTT, right? The linear versus non-linear television, right? Which has led to the whole derating in this sector. And also because of COVID, we have seen other things. So I think at some point in time, stocks become so ridiculously priced and attractive. And as I said, we in this fund, we've done that. Right? We've taken exposure in companies which have been deep value. And we see some signs of things changing there. Like, for example, in this case, the entertainment industry the whole advertising industry should recover along with the economy. I think that should come back. And so it was more of a contra value play with some triggers in terms of recovery of the economy, which will have driven the advertising spend, and also the fact that a company where we are seeing the earlier management, whatever, they had some corporate governance issues earlier, but now with the change in the management, it became professional board coming in. That could drive a lot of change and perception about the company. So some of these factors, I mean, these are things which continues to look at, prompts us to really look at companies which are kind of ignored by the market. And we take small bets over there, right? Because you don't know how long it will languish.
Right.
But whenever the market starts realizing that, and then that's where you get big upside also. And even a small bet in a portfolio can make a difference to the overall portfolio.
I love that. Keep the emotion aside, look at what the merit really is calling out to you, and you take those calls. Mahesh, that has been, for me, a very enlightening experience speaking with you today. Thank you. I think we're running out of time, and I believe the audience have also a lot of questions to ask of you. So thank you so much, Mahesh. It's been a privilege and honor. And over to you, Tarang.
Thank you so much, sir. Thank you. Indeed, as you said, it was really an enlightening session. And the questions were around what's happening today, what happened yesterday, and what is going to happen in times to come. I think from my perspective, it is really important. Mahesh sir gave a guidance that while we have printed so far 400 to 500 bips of outperformance in frontline equity fund for our investors over the last 20 years or so, Going forward, he has given a conservative estimate of maybe 200 basis points additional. Knowing Mahesh sir for more than a decade now, I certainly know that this is the most conservative way. He has always believed in under commit and over deliver. So maybe linking to this question, sir, one of our attendees, Mr. Tushar Jain, has asked a question that since alpha in actively managed funds is reducing, and you also suggested the same, should we shift to passively managed funds? Although you covered a part of it, but I thought let me take this question.
So I think you need to have a mix of both because I still believe that over a long, if your investment horizon is longer term, then a good, well-managed, actively managed fund, okay, which has got a good track record and stability, should generate a slightly better return than a passive fund. There could be periods, okay, where it might underperform the benchmark for various reasons which we talked earlier, but it can still give, and that extra 100 basis point or 150 or 200 basis point is still worth it, right? Because over a longer term, that extra 100, 200 basis point can still make a difference as you, the power of compounding, as you would realize that. So, I mean, if you're looking to just take a market exposure for a short term, tactically, you want to quickly deploy some money into the market, then I think one can look at the passive because that's the best way to take market exposure, right, from a short term perspective. Because you don't know which fund, sometimes which fund to decide to invest into, and you don't know when the fund is good, whether it will really give you that much return from a short term perspective, right? Because each fund has a particular style and they will perform differently vis-a-vis the benchmark in different phases of the market. So if your approach is short term, you want to get a short term exposure to the market, then one can look at passive. But all long term investing, which is there for wealth creation, I think I would still suggest bulk of that should be to the actively managed funds.
Great, thanks. I have a question and a compliment here, sir. Mr. Iyer has complimented Mr. Shrikant and you for lovely outfits that you are wearing. And he has pointed out apparently Mr. Shrikant is wearing a Louis Philippe shirt and you are also wearing an ABG brand.
Good observation.
So he has asked a question that any specific views on the textiles as a sector for the times to come?
Yeah, so textile sector also is seeing a very good current phase. Okay, again, benefiting out of what's happening in China, right? So we've seen China, the cost of manufacturing is going up and the competitiveness is going down. And that is benefiting in India and some of the other countries also in the Asian region. And globally large sources of textile, a lot of the large brands, they are also looking at alternatives to China. And India has got a good ecosystem, right? Fully end-to-end value-added system, right? From spinning, to garmenting, the whole ecosystem is there. So the sector looks fairly promising. And into domestic side, I think the retailing space, as I think the per capita income goes up, and I think people want to spend more on higher end garments, right? And that I think sector will see more shift towards organized also, right? Brand, stronger brands which are there. I think there is still a very fragmented market on the retail side. There's also an opportunity, which is there for people with strong brands and a good retail distribution network to continue to grow and gain market share. So yeah, it's sector which outlook there looks very good, but I think players with having a stronger brand or having a large scale and size, especially on the export side, I think will always have an advantage.
Great, thank you, sir. Here's another question. I think a keen follower of Aditya Birla. He says that our AMC IPO is around the corner. And how are you viewing it as an investment opportunity?
So I can't comment on our IPO, right? Because that won't be right. But overall, at the industry, if you look at, right, the asset management industry is also, again, it's a play on the broader market, how the economy does. But we've seen that the whole industry is seeing a huge amount of, because India is still underpenetrated market in that sense, right? The percentage of people owning mutual funds is still very small, and it's a big opportunity for your community, also distributor community, to continue to grow. And a lot of savings which are there in the economy I think that financialization of savings is a theme which is continue to go. I think a lot of money has gone into real estate in the past, but I think people have realized that, especially the new millennials who are coming in, right, the young generation, and I think they are being much savvier, okay, and becoming much more financially independent much earlier and trying to invest. So I think given these dynamics, I would see a fairly reasonable long-term growth for this industry, and and this industry is also generates good amount of cash flows, right? It's a question about always been about growth, and companies are able to manage talent, have a good track record, have a strong brand and distribution. I think we'll continue to reap the benefits of the overall growth happening in this sector.
One question from my side, sir, and it's been more than a decade as a salesperson. I think frontline equity is darling of every salesperson, and I'll tell you why. This is a product that is more benchmark hugging, where the possibility of a fund manager moving more than 3% in individual segments is limited, wherein despite being closer to the benchmark, our outperformance as compared to the other peers in the industry is competitive, and we always remain in the first quartile, right? Like barring 1 year, which happens with most of the funds, they have their own share of cycles. I think barring 1 or 2 years, I have never seen frontline equity in coming below the quartile 1, quartile 2 of performance. How do you view it going forward, sir? We are focused on maintaining this consistency, or we are focused on maintaining the quartile 1 top performance at all points of time?
So I think our focus has always been trying to maintain the consistency, and that's what's been the track record of this fund. So if you look at it in the last 15 years, right, until 2018, the fund had virtually outperformed the benchmark in every calendar year, right? So only in the last 15 years, probably 2 or 3 years, where the firm has underperformed the benchmark. And that's what I think our endeavor would be, to ensure that we consistently beat the benchmark. And but while doing so, I think we endeavor to be not, I mean, we always want to be in the quartile 2 or upper end of quartile 2 at all points in time, right? Even from a short 1 year time frame, if that's one call as a short-term time frame, is to be in, say, in the quartile 2 and do that consistently, right? We try to be consistent in quartile 1 and quartile 2, so that the long-term performance, the truly long-term performance is in quartile 1 automatically, because if you are able to be even above average consistently over a long period of time, automatically you will be in the top quartile or top decile, right? And if you look at this fund, in the last 15 years, okay, which I've been managing, we've gone through many various cycles, ups and downs, which would be there, but been very steady performer in most of the period. It might not be a spectacular fund at a particular one point in time, but over a longer term, that has meant that the fund over a 15-year period is #1 fund in the large cap category. If you look at the 15-year returns and compare with the large cap funds, very few funds would have that kind of a track record, 16 years of track record, but in that it will still be #1. So I think that's, I think, a philosophy of trying to be consistent, and by doing so, trying to target to be in quartile 2 or quartile 1, right? I mean, ideally we want to not be in quartile 1 also. We don't want to target to be in quartile 1, because then you're taking higher risk. But upper end of quartile 2 is what we normally target, and if it comes in quartile 1, we are happy with it. So that's what our endeavor would be, and that's the style which we'll continue to manage. And the market environment currently is also providing opportunity to do that, because it's whenever the breadth of the market is good, there are more opportunities, more sectors which are doing well, then this style of fund will do well, right? There'll be periods, 1 or 2 years, where it could be a different phase of a market, which we'll struggle, but we'll still try to do our best to ensure that we don't really fall too much below. We're always there so that a bounce back is also much faster and quicker. So we don't really go down also too much, even the market condition is adverse. And ability to fund to really bounce back with the way we manage it, we are more nimble also in terms of our approach, and also willing to accept our mistake and move forward, right? There are always some mistakes or some things will go wrong, but quickly realize that and then move forward, and making some changes in our style depending on the market, right? As I said, we have tried to adapt to some of these new technology companies or disruptors coming in into the market, and also trying to take some exposure over there. So willingness to learn along with what the market teaches us is what I think helps us remain competitive in terms of our performance. And that's what we'll endeavor to do going forward.
Thank you, sir. And just to add to what you said about frontline, giving creating delta and alpha for the investors over the last 15 years. And Mr. Bhagwat also mentioned a lovely point that very few fund houses and fund managers are there who have managed such a large fund consistently for a period of 15 years. You've been managing beautifully for us and the investors at large. Thank you so much, sir, for that. Last question. I think Mr. Arun Anand and Ms. Deepa Malia have been writing questions about the global impact on our markets. So Mr. Anand has an apprehension that it is the tapering announcement that led to the recent correction in the market, while Ms. Deepa Malia has related it to the China's Evergrande crisis, which is getting unfolded. How do you see both these things impacting our markets in times to come, sir?
I mean, both these things have hardly impacted our markets, right? One would have thought in the earlier period, that shows the power of liquidity and what euphoria you are seeing in the market. But yeah, the fact is that one should be aware of these things and don't take it for granted that nothing is going to happen. I think we are in a phase where the market has seen a very vertical rally for a long period of time. And there'll be bounds of period where I think there'll be a correction in the market driven by various factors. It could be this event, what we saw, in China, it could be something in the US, it could be tapering. But I think one has to see that, one should be aware of these risks. Let me put it this way, right? The impact of that, how the market will react is very difficult to predict. Sometimes we expect something to happen and the market really thinks otherwise, right? And behaves other way around. But I think increasingly from here on, one needs to be a bit cautious over here. One should not take things for granted. And we are also pretty cautious at these levels. We had a very good run in the market. We need to protect our gains also, right? And not do any mistakes so that we give away that. And as we move forward, I think latter part or the end of this calendar year, as probably tapering starts to happen, there could be some volatility into the markets, and we are prepared for that. Though I think one should not expect too much of a large correction because we are still in a bull market. I firmly believe that we are in a bull market. We are in a phase where earnings growth and overall economic growth is going to accelerate, and the overall macro environment of lower interest rates and decent liquidity is going to remain there for some period of time. The central bankers are going to be accommodative. So I think one need not be too worried also about these events. There could be a correction, probably a 10% correction in the market, which is, I think, a healthy correction. Don't expect any deep correction at this point in time. And as investors, you should, again, not try to predict that because it's very difficult to predict when the correction will happen. You be systematic, disciplined in your investment approach. We are also trying to ensure that a portfolio, we don't take unnecessary risk, high beta stocks, that even if there's a correction, we're able to withstand that and without really altering the portfolio too much, focusing on bottom-up stock selection so that we buy the good stocks which will continue to work both in a bullish environment or also and give us protection in a kind of a market correction. That's what our endeavor is, I would say. And as investors also, you should, I think it's still a good time to stay invested in the market, right? You can potentially take some gains. Okay, if your allocation has increased significantly, equity allocation, one can take some gains, but still it is merits to have a slightly higher allocation towards equity because I don't see any other asset class giving better returns than equity over the next, say, 2-3 years time frame.
Thank you, sir. Thank you so much. I have a question from Mr. Bhagwat. Sir, Mahesh clearly suggested that while managing frontline equity fund, he is happy to ensure consistency of the fund over being in the top. And he is happy if the fund figures in the top of quartile 2 performance and occasionally maybe quartile 1 performance. How do you think that while managing a client's portfolio or a client's expectation, such funds make their positioning in the client's portfolio? Where do you think that frontline equity will make its mark there, sir, as a advisor?
So our endeavor is always to have top quartile funds. Okay. And obviously we all know it is not possible to have the number one fund and the absolute scheme. But if you're there in the top group, we are always looking for that. And this top quartile is on a risk adjusted return basis. Okay. And what we have also learned from the last few years is that fund managers have their cycles. It's not always party time. Okay. Sometimes managers go through their bad patches. And if we are convinced about the manager and the philosophy and the discipline, we should remain invested. Okay. So something like frontline equity, which has been a core of our large cap part of the asset allocation, okay, I think still merits that. Okay. It would only say get an exit if the alpha keeps coming down such that I might as well be in a passive on a risk-adjusted return basis. But a frontline has been top quartile on a RAR basis most of the time. I mean, Hexagon looks at a 3-year rolling return RAR basis and then does the quartile of peer group. Most of the time, it's only in that 17, 18, 19 does the 3-year quartile rankings dip. And again, if I look at the last 2 quarters, it's again found its mojo. It's come back up. Okay, so I don't think we should have been in a hurry to exit. So realizing that managers go through their patches, we'd rather stay invested unless there's a clear reason to move to somebody else, but there has not been such a clear reason. So I would rather continue my position in frontline equity fund in that sense. Okay.
Fantastic, sir. Thank you so much. And I think it gives credence and confidence to us as salesperson. And also it gives a lot of credence and confidence to the distribution at large that for any fund or any fund houses, these erratic movements are part and parcel of the market. What is more important is the fund is living up to its true label and still continues to deliver returns. Thank you for your thought, sir. And thank you, Mahesh, sir, for this candid conversation. I really enjoyed and I really gained out of this conversation. And I hope that all the participants on this webinar would have enjoyed this conversation and will use to their and their clients' benefit. Thank you once again for joining us.
Thank you. My pleasure.
Thank you. And let me thank Srikanji also for conducting this very wonderful. It was really, he asked the right questions, I think, which also prompted me to really get engaged. So thank you, Srikanji.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.